Hi, Anu Buzruk, Senior Academic Assistant at the Learning Commons of College of DuPage. So in my series of videos explaining the accounting cycle, we will continue, and today I'll be explaining to you as to what is closing of the temporary accounts and creating a post-closing trial balance. So earlier we had come up with a trial balance where we had some cash with us, which had $900 debit balance. Then we had accounts receivables worth $1,500. Then there were some prepaid expenses worth $50. And then we had accounts payable worth $900. We had brought in capital worth $1,000 in the business, and the cost, or before that, the sales revenue that we had earned during the accounting period was $1,500, and the cost of whatever we sold, we had purchased it from our supplier at $900. And lastly, we had incurred some insurance expense worth $50. So in this way, during the accounting period, this was the picture of all our account heads, and the picture was coming to 3,400 debits and 3,400 credits. So now, as you know, trial balance is something which makes you sure that at least to 99.9% you have done everything correctly and all your debits are matching with all your credits. Now what happens is, when you are creating those financial statements, you are going to move them on to the next accounting period to find out how the business is running, how much income you are earning, how much you owe to someone, how much somebody else owes to you. Now in this trial balance, there are certain temporary accounts. They are related only to this accounting period, and they are not going to get carried forward to the next accounting period. So then obviously you need to close them, make them zero, and only the permanent accounts will be moved to the next accounting period. So how to do that closing process? So there are certain journal entries that you will have to write. The very first one is the temporary account sales revenue needs to be closed, because this is the revenue that we earned just for this period. Revenue, as you can see, has a credit balance. Now in order to close that credit balance and zero it down, you will be debiting the sales revenue account with the same amount of money that you have as a credit in that account. Similarly, the expenses are also temporary accounts. You incurred those expenses just for this financial period, so you need to close them and zero them down. As you can see, expenses have debit balances. So in order to make them zero, you will be crediting those expense accounts. Cost of goods sold, you will be crediting it with whatever debit balance it has, that is $900. And there is an insurance expense account of $50 as a debit, so you will be crediting that account with $50. Now as you know, in a journal entry, your debits and your credits should equal, and you can see that there is a difference between the two. Now this difference, we are going to load it on retained earnings account, because that is an account which is a permanent nature account. So we are going to load the difference on retained earnings, and our difference is $550. So as you can see, it is nothing else but the net income that you earned during the period which you are loading on a permanent account, so that after all this process, when you come up with post closing trial balance, all you have over here is all the permanent accounts. That means assets, liabilities, and equity. So in my post-closing trial balance, I still have my cash 900 worth. I still have my accounts receivable 1500 worth. I still have my prepaid expenses because I paid that money ahead of time. So it is my asset $50. I still owe money to the people, accounts payable $900. And I had brought in capital in the business, which is still there, being a permanent account. And now apart from that, instead of these revenue and expenses, what I have is retained earnings, the earnings that I retained or I kept in the business instead of spending that money for my personal reasons. So in this way, when you make a total of all your debits and credits, it comes to 2,450 on both the sides, which again makes it sure to you that you haven't done any compensating, any silly mistakes while doing the accounting process, and you have closed the temporary accounts. All these permanent accounts will move on to the next year or the next accounting period, so that you can start your accounting process and again find out what is your financial position.